The Atlanta Federal Reserve just dropped a major update that's turning heads. The U.S. economy could shrink by 1.5% in the first quarter of 2025, landing us squarely in recession territory. And this news arrives just as President Trump is settling into the White House. We need to figure out what's driving this shift, whether it's a policy misstep, fallout from the last administration, or simply bad timing. I'm going to break down the latest numbers, unpack the political angles, and explain what this means for your wallet, since this isn't just about abstract statistics, it's about how you'll manage your money in the months ahead. Now, here's what's happening right now. The Atlanta Fed's GDP Now tracker, which pulls real-time data from the Bureau of Economic Analysis and the Census Bureau, is taking a hard turn into negative territory. As of February 28, 2025, it's forecasting a negative 1.5% growth rate for Q1, making the first negative outlook in 3 years. Just a month ago, the same model showed a healthy 3.9% growth rate, which means we're looking at a steep drop. Experts are calling it a negative GDP shock, tying it directly to massive data releases last Friday, while Q4 2024 closed out at a solid 3.4%. This isn't a gentle slowdown by any stretch, it's a sharp decline, and with 2 quarters of negative growth defining a recession, we're potentially halfway there if this projection were to hold. Now, let's dive what's into fueling this slide. A swelling trade deficit reveals imports surging while exports remain stagnant, and analysts estimate that the net exports alone sliced over 3 points off the GDP forecast. Companies might be stockpiling goods like electronics, steel, textiles, anticipating Trump's tariff threats will hit soon. But exports aren't keeping pace, possibly because Europe's economy is cooling or the dollar is just too strong for global buyers. Consumer spending is dropping too, with families holding off on purchases like a new fridge or a spring getaway, perhaps still paying off December's credit card bills or feeling uneasy about the future. Government spending isn't helping either. Earlier projections suggested it would stay steady, but the latest tweak shows it's pulling things down instead. All these factors are hitting the economy at once, creating a tough mix. Trade deserves a closer look since it's a massive part of this story. The GDP Now relies heavily on monthly trade reports, and Friday's Census Bureau numbers delivered a jolt, suggesting shipping containers are stacking up at ports like Los Angeles or Newark, unloading faster than they're shipping out. If tariffs kick in, prices will rise quickly, meaning those stockpiles could either save companies money or leave them stuck with overpriced inventory. Analysts describe this as a rapid slide into recession territory. This isn't based on speculation. It's grounded in hard data reflecting what's moving through the economy right now. Now, falling consumer spending only adds to the problem, creating a cycle where less buying leads to more goods sitting idle, further shrinking GDP. Consumer spending itself tells a grim tale that we just can't ignore. The latest figures make it clear that spending isn't just slowing down, it's contracting in key areas. Durable goods like cars, washers, or TVs dropped 0.8% month over month, while services are holding up a bit better. Though discretionary expenses like concert tickets or dinners out are starting to fade. Holiday debt might be lingering as a culprit, with people who overspent in December now pulling back, or it could be uncertainty about jobs, prices, and what lies ahead. The Conference Board's Consumer Confidence Index, updated on February 25th, 2025, slipped from 108 to 103, indicating that people are rattled, and that dip in spending plays a huge role in pushing this negative 1.5% projection onto the table. Now, there's also a shift in how these numbers are being calculated, which adds another layer to the story. Under Biden, the focus stayed on nominal spending, those raw dollar totals that often hit 3 or 4% growth. But now, they're using real spending, adjusted for inflation. And when you strip out the price hikes and inflation, growth under the last administration might have been flat or even negative in some quarters, like Q2 2022, which registered plus 1.1% nominal but negative 0.6 real according to the 2022 study. Trump's team might argue that this shows that the economy wasn't as robust as it appeared, while Biden could say it's just standard accounting. But the key point is that the negative 1.5% is real GDP, offering a tougher, more honest picture than we've seen in the recent years. Stepping back gives us a broader view, and other warning signs are flashing too. Industrial production has been shaky lately, with factory output tied to trade, and if exports stall, plants slow down, and as shown by Purchasing Managers Index, dropping below 50 in January 2025, this signals a contraction, since anything under 50 spells trouble. Retail inventories are climbing as well, hinting that stores overstocked for a holiday season that just didn't deliver. And while these aren't the marquee stats like GDP, they paint a consistent picture of pressure building across production, sales, and trade. Politics is impossible to avoid in this mess. Trump has been in office for a month, and when Biden stepped out, GDP forecasts hovered around 3%. Based on older GDP now adjustments, critics argue that tariffs chatter is shaking things up, with businesses hoarding goods and consumers holding off, directly linking the spending drop to tariff uncertainty. Trump supporters claim it's Biden's policies finally cracking, since 3 years of growth don't just disappear overnight, and supply chain snarls or inflation battles could be catching up now. Both arguments hold water. Economies shift gradually, but new decisions can deliver a jolt, making this feel like old momentum slapping into fresh challenges. The speed of this change is catching attention everywhere. Just days before February 28th, the model sat at maybe negative 0.5%. Not ideal, but manageable. Until Friday's trade and inventory data flipped everything around. After that data landed, the forecast cratered, rooted in solid census data and BEA updates, not shaky guesses. Some think it's too soon to hit the panic button, suggesting that trade spikes might ease off, while others see a deeper trend, arguing growth has been wobbly for longer than we've admitted. And when a tool this reliable raises a flag, you don't just shrug it away. Now, what does this mean for your money? Jobs could turn shaky if a recession were to roll in, since companies often freeze hiring or cut back when times get tough. So folks in tech, retail, or manufacturing should start networking now. If your job's steady, build that cash reserve. 6 months of expenses keeps you covered no matter what. Spending is down, opening the door to deals on cars or appliances, but you'll need cash on hand to grab them. Investments might face some turbulence ahead, with stocks already jittery awaiting PCE inflation data, and this GDP news could rattle them even further. Growth stocks may falter, but utilities and food companies could stand strong. Cash at 1% isn't exciting, yet it's a safety net when markets slide. Now, let's unpack the investments a bit more, since this gets personal fast. If you're deep into tech or crypto sectors that thrive on big growth, losses might be looming. With traders already bracing for a sell-off, imagine $10,000 in a tech stock. A 10% dip wipes out $1,000. So shifting some steady options like household goods or energy firms with 3 to 4% dividends could even things out a bit. Bonds are trickier. If inflation were to spike, rates might climb and prices drop, meaning a 10-year treasury at 4% loses value if rates hit 5%. Holding short-term treasuries or cash gives you flexibility, and the takeaway here is clear. Don't put all your eggs in one basket. Sectors will feel this in totally different ways, which matters a lot. Manufacturing is already taking a hit, with less demand and slow exports suggesting plants might cut shifts, while retail is stuck with excess stock. So if spending stays low, expect sales or layoffs. Construction could slow too, since higher rates from inflation worries make mortgages pricier and fewer homes get built. But healthcare and utilities tend to hold steady, because people don't cut meds or power regardless of the economy. Now check where your job or investments land. Some industries flex and just brush it off, while others snap. Politics flow straight into your budget, and it's getting messy. Trump's tariff plans include 10% on all imports and 60% from China, with CEOs bracing for the fallout. If those land, your phone, your jeans, your groceries, they're all going to cost more. And since businesses pass those hikes on to consumers, a $50 shirt might jump to $55, and it all might start adding up. Inflation has been pretty calm so far, but this could spark it again, leaving the Fed in a tough spot. If you raise rates and your $300,000 mortgage climbs from $1,800 to $2,000 a month, cut them and savers get stuck with nothing. Credit cards at 18% might creep to 20%, adding $200 a year to a $10,000 balance. So you need a plan for either outcome. History offers some perspective, and since 2020 doesn't really fit in, we can look back at 2008, 2009. GDP tanked 4.3%, peak to trough, driven by housing and bank collapse. The 2001 dot-com bust sparked a milder 0.4% dip. This negative 1.5% isn't at those levels yet, but it's the first negative mark in 3 years, and unlike those times, trade's the big mover now, not housing or tech bubbles. And here's what you can do now. Build up a cash reserve, cut any unnecessary expenses, any unnecessary subscriptions that you're not using anymore. Check your investments and shift them from riskier bets to a little bit safer bets. Keep an eye on the market and GDP now and see how things shake out. But you should really avoid the political blame game and stick to data like Friday's trade stats or next retail numbers to stay ahead of this. Step back for a second. This negative 1.5% is a wake-up call. The first negative in 36 months, and whether it's tariffs, trade gaps, or an economy running dry, something is clearly off. Let me know what you think down below. Do you think we're going to go into a recession? Do you think this is just politics at play? Or what do you think's going on? Thank you so much for watching. If you enjoyed this video, please give it a like, subscribe, and I'll see you next time.